Most people, when they're starting to invest, are searching for the perfect company to buy. That's why they are constantly searching for what companies should I buy? What stocks should I invest in? But if you're trying to choose a company from the thousands that are listed on the stock exchange, it can be really overwhelming. It's far simpler and far more effective if you first eliminate those that you do not want to invest in. So your first step really should be to eliminate all of the companies or funds, this works for funds as well, that don't fit your investing criteria. And that's going to be different for everybody because everybody has different goals. But first you need to cut out the companies and the funds that don't fit your investment criteria. That way, as you eliminate companies as you go, you're going to narrow down your focus and only be left with, hopefully, 10, 20, maybe even 50 companies that do fit your investing criteria. And then you're going to have a far easier time choosing from those companies than you are from thousands of companies. So let me show you how I do this so you can adapt it to your own investing criteria. First, using a stock screener is a great way to start eliminating and creating your do not buy list. You can use these screeners to filter on size of the company, the performance over the last 12 months, 3 years, 5 years, whatever time frame that suits you. You can filter on dividend yield, all sorts of things. And once you have that list, you can sort by the metric that is most important to you. Now, most trading accounts have some sort of stock screener built in. There are some free ones online, but do be careful with some of the free ones. Just overall, be careful. Don't download anything you're not sure about, and don't enter any personal information. Marketindex.com.au is a really great site for research. They have some pre-run scans under their stock scans tab at the top. I'm not affiliated with this website, I just use it a lot. So if you go to all scans, you can see all of the scans that they have. So they have things on activity, trading volume, dividends, director changes, trading signals if you're interested in different charting, trading signals, performance signals, anything that you might want to look at. For example, if we go and look at the highest dividend yields and view that scan, they have pretty much the same criteria that I use, which is a high market cap, dividend yield of 5% or more, and they rank it by dividend yield. So this is just an easy way to go in and have a look. So these scans are actually really helpful. I generally use the one that's built into CommSec though. It can be a little clunky sometimes, but that's the one I use the most. So if you have CommSec, this is where the screener is. It's under Quotes and Research, Find and Filter Stocks. And then you can just go and put whatever criteria you are. I usually use View by Dividends. Then I'll add the criteria that I want, which is the ASX 200 and the dividend yield. You can change the little slider to whatever you want. I usually put 4% or higher, even though I'm looking for 5%, just in case there's some companies that I might consider. Then I just sort by the highest dividend yield to the lowest dividend yield. Now, CommSec does take a while to propagate this. They're a bit clunky, like I said. You have to keep scrolling down for it to get all the results, which is a little bit annoying. But then I just put it into a spreadsheet when I'm ready to use the data. Also, your do not buy list doesn't have to include companies that just don't fit certain performance criteria. It can have anything that you don't want. So maybe there's some ethical reasons you don't want to invest in certain companies. Maybe you just don't like what the company does and don't want to invest in it. Or maybe you just don't know anything about the company and only want to invest in companies that you know something about. Those are all perfectly valid reasons to have a do not buy list. It's going to be personal to you and what you do not want to invest in. It doesn't have to just be performance based. It can be value based as well. In fact, I think some of the best do not buy lists have and do incorporate your values into what you want to invest in as well. So your aim is to get that list under 50 companies, or under 20 even is better. So here's what is on my do not buy list. Again, it's going to be different for you, but this is what's on my do not buy list. This is my criteria. These are the companies I just won't purchase for whatever reason. So the first is I do not buy small cap stocks or any company that has low trading volume. So that's why I usually concentrate on companies that are within the ASX 200. So that way I'm already narrowing down my field to just the top 200 companies. I sometimes will go outside the top 200 companies, but I won't buy a small cap or a company with low trading volume. That's just a personal preference. Now, if you're an investor that likes those small companies because you like the potential growth, that's completely different. As a dividend investor, I just don't buy small cap stocks. That's on my do not buy list. Obviously, as a dividend investor, I do not buy companies that don't pay dividends. Again, other investors don't have this rule, but I do as a dividend investor. It's an obvious one, but yeah, I don't buy companies that don't pay dividends. I also won't buy companies that pay very low dividends. Now, generally, when I'm searching, I'm looking for a dividend yield of 5% or more that grows over time, so that the longer I hold, the higher that dividend yield becomes based on the investment that I started with. And while sometimes I will go lower than 5% if it shows consistency and good growth, generally, I don't buy low dividend stocks or no dividend stocks. Now, I also do not buy companies that have decreased in price over the last 5 years. This is going to depend on what the market itself has done over the last 5 years. And we all know that companies can turn around. But just because I like nice stable stocks, I do not buy companies that have decreased in the last 5 years. Now, of course, some investors love these companies because if they turn around, they can make good money. It's just not something that I invest in, so that's on my do not buy list. I will, however, hold a company that is decreasing in price, although I do keep a watch on it, and I might consider when I do a portfolio rebalance getting rid of it. But generally, I'm not as concerned once I'm holding a company, because if a company is still paying consistent high dividends, usually the company is pretty sound anyway. The dividends are usually the first thing to go if a company is in trouble. So I generally think that the company will turn around in the future if I'm already holding it. And I don't like the capital gains tax, so I'm very reluctant to sell once I hold something. I will, but I'm reluctant to. So those are the criteria that I use to narrow down my list. Those are on my do not buy list. So my co-host just jumped up and wants to come into the video. Hello. Hi, Peppa. Hey. So those are the criteria that I use to narrow down my list. I want things in the ASX 200. I want a good dividend yield. I want consistency. So I will eliminate all of those companies that do not fit the criteria. So I'm left with a list of 20 or so companies. And if you've seen any of my what to invest in videos, you'll see that I use that elimination strategy quite often when trying to come up with companies that I would invest in. Now, so what happens once you have this list? Next, I would put all of those companies, say you've got 50 or 20 or however many you have. If you've got more than 50, then you need to do more elimination and you need to narrow down that list even further. But once you have that list, put them in a watch list. Again, most trading platforms will let you create a watch list. A lot of regular websites will let you create a watch list as well, or you can just create your own in any sort of spreadsheet program. And that way you can just keep an eye on how it's performing. And then when you're ready to buy, you can go into that list and see which one of those companies is performing the best. You can also create as many different watch lists as you want. You can create one for dividends, you can create one for performance, you can create one, whatever criteria is important to you, have a watch list for it, just so you can keep an eye on those companies just to see what they're doing. You don't have to check in all the time, but anytime you're ready to buy, I would go and have a look at those companies to see which is the next investment you want to have. So creating that do not buy list is one of the easiest ways to find the companies that you do want to invest in. Eliminate all of those companies that don't fit your investing criteria first, and then you can choose from those companies because they're all probably going to be great and fit your investing style. Good luck with your investing and happy 2025. See ya!